Celsius made a pretty interesting move late last week buying Big Beverages, a contract beverage manufacturer. This is one of their co-packers. This is the company that actually makes Celsius beverages. If you didn't know this, Celsius itself, at least until this acquisition, did not make any of its own beverages. It basically formulated the product, did the branding, did a lot of the sales legwork, but it was a very asset-light company. This changes that a little bit. So a little bit of a strategic shift. Not necessarily all that surprising, and this is actually something that Coca-Cola over the course of the past 100 years has kind of gone back and forth, buying some of its co-packers, then spinning them off, then buying them back again. So this could be the start of a long journey for Celsius, but I want to go through exactly what the deal was and why it is an interesting strategic move for the company. My name is Travis Hoium. Thanks for watching Asymmetric Investing. Please subscribe here on YouTube for all my content, and thanks to this video sponsor, The Motley Fool. If you go to fool.com/ASYM, they'll give you their top 10 stocks to buy right now. So let's look at the announcement that Celsius made. And this is the press release. Celsius Holding boosts innovation and production capabilities with strategic acquisition of Big Beverages contract manufacturing. Interesting that they're spinning this as an innovation play. I don't know that I necessarily buy that, but we'll go through some of the details here. $75 million is the price tag. Acquisition was already completed on November 1st. So that closed on Friday. Celsius now officially owns this company. Celsius gets 170,000 square foot facility, modern manufacturing. I'll show some of this in just a second. And then has greater supply chain control, quicker innovation cycles, and greater production flexibility. This is really the reason that Celsius is making this move, is that they actually now start to control some of their supply chain. Remember, they made the deal with Pepsi a couple of years ago. That's their distributor, but it's not actually the producer of their beverages. So this is a vertical integration move, a plant that is already primarily dedicated to Celsius beverages. There are expansion opportunities, per case savings. This is going to be the thing that financially we're going to see. Yes, there's some upfront costs. It makes this a little bit more of a capital intense business, but you should see margins go up a little bit because the margin that was taken by these co-packers is now going to be included in Celsius's margin. So a little bit of a balancing act there. Solid return on invested capital. We're obviously not going to know some of those internal numbers, but it is going to be earnings per share accretive potentially. This is an interesting word to end this with. And they say that they think that this is going to accelerate their product innovation and production capabilities so they can continue growing in the energy drink category. And this company was just founded in 2019. So it's relatively new, probably grew very, very rapidly along with Celsius. And let's look at what this manufacturing facility is. You can see these are Celsius cans that are actually being filled right here. So that is actually what they're showing, but new manufacturing facility, able to do all the mixing and filling of cans. They end up packaging everything themselves as well. And this is, like I said, this was a co-packer is what Celsius would call them. But it's basically just a contract beverage manufacturer. So if you buy Celsius, if you buy Coca-Cola, if you buy 5 Hour Energy, almost all of those products are now made by some sort of a contract manufacturer that has either an exclusive deal with the beverage company or just a large deal with the beverage company. There can be lots of different beverages made at these facilities, and they're actually all over the country. So interesting that they're starting to vertically integrate, but that's the thought process behind it, is you pull some of their margin into Celsius. You have a little bit more control over that supply chain. You can still offload any of the other demand to other co-packers. So theoretically, you could run this facility at full speed, provide as much product as you possibly can, and then offload anything else to other co-packing facilities. Thanks to our friends at The Motley Fool for sponsoring this video. Visit fool.com/ASYM for the top 10 stocks to buy right now. So why is Celsius doing this? The easy answer is that they want to regain at least a little bit of control of their supply chain. If you look at the way that their current supply chain works, they're giving demand signals to their co-packers who then have to produce product. They have to carry inventory. Then Pepsi, which is their primary distributor in the US at least, is going to carry inventory in their warehouses. Then it's going to go to store shelves, which is going to be more points of inventory. So you have 3 major points of inventory before you actually get a product into a customer's hands. Inventory has been the biggest problem for Celsius this year. Earlier this year, management said that Pepsi was going to do about $100 million less in orders this year just to adjust their inventory. So it looks like end market demand continues to rise for Celsius's products. They're continuing to gain market share. You're seeing it more and more on store shelves. But that inventory, which is a little bit like filling up a swimming pool. If you fill it too high, it overflows. If you don't fill it enough, you can't go swimming. So this is the challenge that every company in the supply chain has to deal with. So owning the co-packer at least gives you a direct line to your biggest distributor, which is Pepsi. That's going to give you a little bit more control in there. The innovation piece, I'm not sure that I really think that is going to be a huge driver. If you do own the facility, you can at least test out, is there efficiencies that we can do with bottling? Is there different things we could do with packaging? There's maybe different things, but all these co-packers and partners and suppliers are going to work with you on those kinds of things anyway. So I don't think that's necessarily a big deal. But the big thing for investors to know about is just trying to take risk out of the system. And that's by managing their inventory a little bit better. So what should we be expecting? For the rest of the year and from a margin perspective from Celsius going forward? This is their growth chart. And you can see that $100 million in reduced orders from Pepsi is definitely going to be a hit on the top line, but this is still a business that you look long-term continues to grow at a really rapid rate. This goes back to 2021, compound annual growth rate is 93%. That's not going to continue, but we could see a consistent growth rate that's more in the 20% range. And if that's the case, this is a pretty good value stock. Looking at the valuation right now as I'm recording, the trailing price to earnings multiple is just under 30. That's pretty good if you're going to have a high growth company. Enterprise value to sales is 4.9 on a forward basis. Analysts obviously expecting profitability to get a little bit lower. Forward price to earnings multiple is about 41. Forward price to sales is 5. So what that tells you is that investors and analysts are actually expecting sales and profitability to get worse in the future. There are some indications that they are going to have to do a little bit more discounting to be able to keep growing. If you've been to a big box retailer or a grocery store, you're probably seeing there's more discounting, not only on Celsius products, but also across the board. I mean, there's deals basically everywhere in the grocery store these days. So we'll see what those pricing numbers look like. But that's why the stock is down as much as it is. As I'm recording, the drawdown from the peak, 67%. So this is only a company with a market cap of $7.3 billion today. I think that's a reasonable risk reward for Celsius. Doesn't mean that the next quarter, which is going to be released next week, is going to be great. But it means that long term, I think that this is still a company that has a lot of runway. It has much more appeal to a broader audience than a lot of competitors like Red Bull, like Monster. So I think there's a lot of growth ahead, but there are some growing pains. And one of the growing pains is trying to get control of your inventory. When you're growing 100%, everything seems great. Suddenly that slows down. Now everybody gets a little bit more concerned with efficiency. That's what this move is about in my eyes, not necessarily innovation, but just getting better control of their supply chain and their cost structure. We will see what management has to say about that, and then over the next year or so, how that plays out in the financials. But I continue to be bullish on Celsius, but it takes a long-term view with this stock. So let me know what you think about Celsius in the comment section below. Don't forget to subscribe to Asymmetric Investing. Thanks for watching, everybody. See you here next time.